Bring in MacroMavens founder, Stephanie Pomboy. Stephanie, it's not the first, it won't be the last. Why will this be even worse than 2007, 2008?
Well, I think it's interesting that everyone's characterizing this as stunning in terms of the speed with which this bank collapsed. I think, frankly, the surprise has been that it has taken this long for something to break. I mean, we have undergone the fastest, most aggressive Fed rate hikes in history, far more aggressive than Volcker and certainly far more aggressive than anything we saw that led up to the global financial crisis in 2007-8. And the reality is they're doing it all against a backdrop of an incredibly leveraged economy and a financial system outside the regulatory purview, the part that's outside the regulatory purview of the Federal Reserve, that's been really run kind of like the Wild West. And now we're discovering just how much so. So I do think this is the tip of the iceberg. I think we'll see a lot more stories like this. And then I do think that the problems will bleed out, as they invariably do, to other parts of the market. And I'm thinking specifically, Dagan, about the corporate bond market. You know, a lot of the VC companies that were involved with this bank have been buying up these zombie companies and lathering up debt on them and trying to spin them out. Those zombie companies have over $1 trillion in debt that's going to evaporate. And a lot of people are going to be left holding the bag when that happens. So this is just the beginning of the story as far as I'm concerned.
So, Stephanie, we had a stronger than expected job numbers today, over 300,000. And so that will lead us to believe that the Fed is going to keep raising rates. But if they keep raising rates, I imagine that's going to mean more pressure on more banks. So do you see maybe a pause because of the pressure on the banks from the Fed?
Well, I guess the question is the banks that the Fed has been regulating are probably going to be fine. I mean, I guess there'll be some reverberations in terms of confidence. And frankly, the banks are being very greedy because you can get 5% on a 12-month T-bill, and yet they're holding deposit rates below 1%. So they're going to have to raise those rates if they want to keep their deposits, because, you know, deposits are now declining at the fastest rate in several decades. So this is a story that they can address, and they can, you know, fix that problem. But I think that, yeah, as relates to the Federal Reserve, so they're not going to be concerned about sort of a 2008-style meltdown in the banking sector per se. But the blowback to the broader economy here will be meaningful. And I guess it depends on how quickly that becomes evident. And frankly, this morning's payroll report is just more of the same in terms of keeping the Fed's feet to the fire. We got some relief on the wage front. And you are seeing, you know, internally things like part-time jobs are where the growth is, and full-time jobs are slowing dramatically. That's typically been a recession signal. So we'll start to get some traction on these numbers. But you know, the Fed has talked tough and insisted it's going to hold rates higher for longer so often here that I think they'd look pretty ridiculous to pivot immediately and rush to bail out any of these players who were, frankly, irresponsible.
Stephanie, it's just reading your notes. It is absolutely insane, though, that regulators in Washington and even the Federal Reserve wouldn't know that this was at least a possibility, given the fact that last year was this horrific bear market in treasuries because of what the Fed was doing with rapidly raising interest rates. And the anniversary is coming up next week of the first rate increase. But also the stringent changes in capital requirements where the banks were forced to hold treasuries. So essentially, when money starts going out of the door in deposits, there's these banks like SVP are sitting on losses. And so when you have to start realizing those losses, boom, you need to raise capital. It's very simple. But I want you to listen to Janet Yellen. She was the Treasury Secretary. And she's saying, oh, no, don't worry. This is isolated. Listen to this.
I will just say you mentioned Silicon Valley Bank. Their are recent developments that concern a few banks that I'm monitoring very carefully. And when banks experience financial losses, it is and should be a matter of concern.
Help us.
I was just laughing because if that is not the most unconfidence-inspiring commentary, I don't know what is. I mean, it's terrifying. But as you said, Dagan, this is all totally predictable. When you force the banks to hold nothing but treasuries and agencies, and you ratchet up interest rates at the the fastest pace in history, and drive sharp losses in those same quote-unquote risk-free assets, you're going to create some dislocations. And I think probably what happened is that the fact that nothing untoward had occurred over the last 12 months imbued their confidence that, hey, actually, maybe everything's going to be just fine. So they continue to talk tough and keep raising rates. Meanwhile, I keep trying to describe this not as a tightening cycle, but as an interest rate shock. And the full force of that is going to make itself known in a hurry. And I think we're now starting to see that unfold before us. And that should really accelerate big time. As you mentioned, we're at the 1-year anniversary, and a lot of stuff happens, in terms of debt that matures, et cetera. And now we're going to have to roll debt at much higher rates, and we'll see how that goes over.
Stephanie, great to see you. More time. Always. I want more time with my Pomboy.
So smart.
Thank you so much.